A cargo ship leaves China today. It will take about 30 days to reach Europe. But the money for that cargo? It already moved. Yesterday. Maybe last week. In fact, trillions of dollars just changed hands while you were asleep. No ships, no trucks, no warehouses. Just numbers sliding across screens at the speed of light. That gap between how fast money moves and how slow the real world moves is one of the most dangerous features of the modern economy. And almost nobody talks about it. Because when money outruns reality, things break. Quietly at first. Then, all at once. Let's start with why this matters right now. Over the past decade, the global economy has become incredibly efficient at moving capital. Faster payments, instant trades, automated decisions, algorithms reacting in milliseconds. But the physical world hasn't changed much. Oil still has to be drilled. Food still has to grow. Ships still cross oceans. Factories still take time. We've built a system where the financial layer moves at internet speed and the real economy moves at human speed. That mismatch is not just a technical detail, it's a structural risk. To understand why, we need to zoom out and strip this down to its simplest form. Imagine a farmer and a baker. The farmer grows wheat. The baker turns wheat into bread. In a basic economy, goods and money move together. Wheat goes one way. Payment comes back the other way. Slow, but stable. Now add banks. The baker doesn't wait for sales to buy wheat. He borrows. The bank creates money with a keystroke. The wheat is delivered later. Already money has moved ahead of goods. Now add global trade. The wheat becomes steel. The baker becomes a factory. The neighbor becomes another country. Payment is promised today. Goods arrive weeks later. Still manageable. Now add financial markets. The payment itself can be sold, insured, sliced into pieces, resold again. At this point, the money tied to a single shipment of goods might trade dozens of times before the goods even exist. That's where things get strange, because money stops being a reflection of reality and starts becoming a bet on reality. Here's the key idea. Modern money doesn't wait for things to happen. It prices them in advance. Markets don't trade what is happening. They trade what might happen. Oil futures trade barrels that haven't been pumped. Stock prices trade profits that don't exist yet. Currencies move on rumors, expectations, and guesses. Most of the time, this works. But when expectations run too far ahead of reality, danger builds silently. Let me show you how. In financial markets, speed is everything. If you can move money faster than everyone else, you win. Milliseconds matter. Microseconds matter. Entire industries exist just to shave time off transactions. Faster cables, closer servers, automated trading systems. Meanwhile, the goods those trades are based on are stuck in traffic, at ports, in factories, on trains. This creates a strange situation. The price of something can change 10 times before the thing itself moves even 1 inch. That sounds abstract, so let's make it concrete. In 2020, global shipping slowed down, ports clogged, containers backed up, factories shut down. Goods moved slower, money didn't. Financial markets instantly reacted. Prices jumped, companies were revalued overnight. Supply shortages were priced in immediately, but the physical shortages took months to show up on shelves. So what happened in between? A massive gap. Companies raised prices before costs fully arrived. Investors piled into winners before production caught up. Speculators bought and sold expectations, not products. For a while, it looked like growth, until reality arrived. And when it did, it didn't match the price. This is the uncomfortable math most people miss. Financial value today is often built on future assumptions. But physical production has limits. You can't speed up a harvest by clicking refresh. You can't double shipping capacity overnight. You can't instantly replace missing raw materials. So when money races ahead, it builds pressure. Think of it like this. Money's a claim on goods, not goods themselves. When claims multiply faster than goods, something has to give. Either prices rise, or expectations collapse, or both. This is where irony creeps in. A system designed to allocate resources efficiently often ends up amplifying shortages because money moves first. When investors sense scarcity, they don't wait. They buy now, they hedge now, they lock in future supply now, which pushes prices higher today before the shortage fully exists. That price signal then feeds back into the system. Companies rush orders. Governments panic buy. Consumers hoard. And suddenly the shortage becomes real. Not because goods disappeared, but because money moved faster than coordination. This isn't new, by the way. We've seen versions of this throughout history. But the speed is new. In the past, it took weeks or months for information and capital to travel. Today, it's instant. That changes behavior. It rewards anticipation over patience, speculation over production, speed over resilience. And it creates a fragile equilibrium, because when money can exit instantly, but goods can't, shocks don't absorb smoothly. They snap. Here's another uncomfortable mechanism hiding underneath: leverage. Much of the money moving around isn't even real money in the traditional sense. It's borrowed, multiplied, layered on top of itself. A single dollar can support many dollars of financial claims. As long as confidence holds, this works. But confidence is faster than steel. The moment expectations shift, money can vanish instantly. Positions unwind. Credit tightens. Liquidity disappears. Meanwhile, the goods tied to those positions are still sitting there, half built, half shipped, half sold. This is why financial crises often feel sudden. The physical economy doesn't collapse overnight. The money layer does. And because money coordinates production, everything downstream freezes. Factories pause. Trade stalls. Jobs disappear, not because people forgot how to make things, but because the financial signals broke first. There's a quiet absurdity here. We treat financial markets like they're smarter than the real world, more efficient, more accurate, but they're often just faster at being wrong. Speed doesn't guarantee truth, it just guarantees reaction. Now zoom out. On a global scale, this gap creates power imbalances. Countries with strong financial systems can move capital instantly. Countries that produce physical goods move slower. Money-rich economies can pull value forward. Goods-producing economies wait. This shapes trade, debt, and dependency. It's also why currency crises can erupt before shortages appear, why capital flight can devastate economies that still have factories and farms. Money leaves first, reality follows later, and by the time the damage shows up in the physical world, it's too late to reverse easily. So why is this dangerous now specifically? Because the system is more interconnected than ever, more leveraged, more automated. Algorithms don't hesitate. They don't pause to ask if ships are delayed or crops failed. They react to signals. If enough signals flip at once, money doesn't walk away. It teleports. That makes the global economy look stable, until suddenly it doesn't. And here's a final twist. We keep trying to fix real-world problems with faster money, faster payments, more liquidity, bigger interventions. But speed was never the bottleneck in the physical world. Time was, and still is. You can't print a port. You can't stimulate a supply chain into existence overnight. You can't algorithm your way out of material limits. So we're left with a question. In an economy where money moves faster than goods, who is actually in control? The people making things or the numbers predicting them? And if the predictions keep winning short term, how long before reality sends the bill?